3 changes quietly took effect this year, and together they can save some retirees thousands of dollars. But most people over 65 will let at least one of them slip by, not because they're careless, but because nobody told them plainly. I'm talking about a brand new $6,000 tax deduction that a lot of seniors haven't claimed, a Medicare change that finally caps what you pay for prescriptions, and a Medicare surcharge you can get reversed with a single form if your income dropped. No fear, no fake deadlines. These are real, they're already law, and each one is worth checking before this year is out. Let me walk you through all 3, exactly who they're for, and the one move each one takes. I'm Jeffrey. On this channel, we do the honest version of retirement money, the actual IRS and Medicare rules, what's real versus what's hype, and the specific step that turns interesting into dollars in your account. So here's the deal for the next 20 minutes. 3 changes. For each one, I'll tell you what it is, whether it applies to you, the exact form or number you need, and how to fix it if you already missed it. Keep a pen handy. By the end, you'll have a short checklist, and I'd bet at least one of these 3 is sitting there with your name on it. And before we start, let me name why these slip past sharp, careful people all the time, because it's not what you'd think. Nobody mails you a letter that says, "Good news, you qualify for a new deduction." Nobody calls to tell you the Medicare cap kicked in or that a form could cut your premium. What you owe gets taken out automatically, but what you're owed, you have to go ask for. So the people who do best in retirement aren't the ones with the fanciest advisor. They're the ones who know which ordinary rule applies to them and take the one step to claim it. That's all today is. 3 rules and the step for each. Let's start with the one that's pure tax money. Change number 1, and this is the one people seem to miss the most. Starting with the 2025 tax year, there's a brand new deduction just for seniors, $6,000 per person who's 65 or older. If you're married and you're both 65, that's $12,000. And here's the part people get wrong. This is not the same as the standard deduction, and it's not the same as the extra little bump people 65 and up already got. It stacks on top of both. It's a separate, additional deduction created by the 2025 tax law, and it runs through 2028. So, who actually gets it? You qualify if you're 65 or older by the end of the year. For the 2025 return, that means born before January 2nd, 1961. There's one number worth being precise about. It starts phasing out once your income passes $75,000 if you're single, or $150,000 for a couple, and it shrinks from there. So if you're under those lines, you get the full amount. Above them, a reduced version. Be honest with yourself about where your income lands. A pension, plus Social Security, plus a few withdrawals, can cross $75,000 faster than people expect. You claim it on the new Schedule 1A with your 2025 return. Now, here's the action and the part that can actually pay off. If you've already filed and you didn't take this, or your preparer didn't, you are not stuck. You can file an amended return, Form 1040X, to claim a deduction you were entitled to and missed. I'm not promising everyone a refund, it depends on your numbers, but a $6,000 deduction you skipped is exactly the kind of thing worth a 5-minute conversation with whoever does your taxes. If you want the full breakdown of this deduction, how it stacks, the income lines, the worksheet, I did a whole video on just this one, and I'll point you to it at the end. Let me make that $6,000 concrete, because a deduction is abstract until you see it as dollars. A deduction doesn't come off your tax bill directly. It comes off the income you get taxed on. So if you're in, say, a 12% bracket, a $6,000 deduction is worth somewhere around $700 off your actual tax. A married couple, both 65, taking the full $12,000, could be looking at roughly $1,400. These are round illustrations, not your exact number, but that's the scale we're talking about. Not a coupon, a real chunk of money, every year from 2025 through 2028, just for being 65 and knowing to claim it. And here's who I want to make sure hears this. The person who does their own taxes with simple software, or the person whose return is so straightforward they assume there's nothing to optimize. Those are exactly the people who miss a brand new deduction, because the software prompts and the old habits haven't caught up to a law that's only a year old. If that's you, or that's your mom or dad, this is a 5-minute check that's well worth your time. That's change number 1. 2 and 3 are about Medicare, and they're just as real. And let me clear up the single biggest confusion on this one, because it's where people talk themselves out of money they're owed. You do not have to itemize to get this. A lot of seniors hear deduction and think, oh, that's for people with mortgages and big write-offs, not me, I take the standard deduction. This is different. This new senior deduction sits on top of whatever you were already taking. Standard deduction person, you still get it. The other thing people ask is the phase-out again. And the honest answer is it depends on exactly where your income falls, relative to those $75,000 and $150,000 lines. Plenty of middle-income retirees get the whole thing. Some upper-middle ones get part of it. The mistake isn't claiming it when you shouldn't, it's skipping it without checking. So check where you land before you decide it's not for you. The second change is a Medicare change, and it's the best news on this list for anyone who takes expensive prescriptions. For decades, there was no ceiling on what Medicare Part D drug coverage could cost you out of pocket. People with serious conditions could pay thousands and thousands a year with no end in sight. That's over. There is now a hard annual cap on what you pay out of pocket for covered Part D drugs. For 2026, that cap is $2,100. Here's what that actually means in plain terms. Once what you've paid out of pocket for your covered Part D prescriptions adds up to $2,100 in a year, you pay zero for those covered drugs the rest of the year. Zero. For a retiree on a couple of brand-name medications, that can be the difference between a manageable year and a frightening one. And it resets every January, so it's a yearly protection, not a one-time thing. Let me clear up how that cap actually works, because people picture it wrong. It's not that your drugs are free all year. You still have your plan's deductible at the start, and then you're in a stretch where you pay your share, usually 25% of the cost, of each covered prescription. But the system is now counting every dollar you personally pay. The moment your out-of-pocket total crosses that $2,100 line, a switch flips, and covered Part D drugs cost you nothing for the rest of the calendar year. So, the worst-case year, the one that used to be financially terrifying for someone on a pricey specialty drug, now has a known ceiling. You can actually plan around it instead of dreading it. And there's a second piece to this that's genuinely historic. For the first time ever, Medicare negotiated the price of some of the most common, most expensive drugs directly. And those lower prices took effect January 1st of 2026. We're talking about 10 widely used medications in this first round. Blood thinners like Eliquis and Xarelto, diabetes drugs like Jardiance and Januvia, heart failure and arthritis drugs. If you take one of these, the negotiated price can lower what you pay. You don't have to do anything to get it. It's built into your plan now, but it's worth knowing why your costs may look different this year. Let me name a few of those 10, because if one of them is in your cabinet, this matters to you specifically. The first round hit some of the most common medications retirees take. Blood thinners like Eliquis and Xarelto, the ones a lot of people are on after a heart issue or for atrial fibrillation. Diabetes drugs like Jardiance, Januvia, and Farxiga. Entresto for heart failure. Enbrel and Stelara for autoimmune conditions like rheumatoid arthritis. Imbruvica, a cancer drug. And the Novolog and Fiasp insulins. These aren't obscure. They're some of the highest spend drugs in the whole Medicare program, which is exactly why they were picked first. If you take one, you don't sign up for anything. The lower price is just baked into your plan now, but it explains why your costs this year might finally look a little less brutal. Two more quick ones in the Medicare bucket, because they matter a lot for the right person. If your income is limited, there's a program called Extra Help that can slash your Part D premiums, deductibles, and copays. A lot of people who qualify never apply because they assume they earn too much. It's worth 2 minutes to check. And insulin under Part D is capped at $35 a month. If you're paying more than that for insulin, something is wrong with your plan setup, and it's worth a call. The full Medicare timing and enrollment picture, when to sign up, the penalties, the windows, that's its own video. And it's the one I'd watch next if Medicare is on your plate. Let me say a little more about Extra Help, because it's the one people leave on the table the most. It's a federal program that helps lower-income folks on Medicare with their Part D drug costs, premiums, deductibles, and copays, sometimes down to almost nothing. The reason people miss it is a single wrong assumption. I make too much to qualify. The income and asset limits are higher than most people guess, and they get adjusted, so the only way to actually know is to check, not to assume. You apply right through Social Security, online, or by phone, and it's free to apply. If money is tight and prescriptions are part of why, This is 15 minutes that can change your monthly budget. Don't self-disqualify. Let the rules tell you no. Don't tell yourself no. Here's the practical takeaway that ties the whole Medicare piece together. Because the rules changed, the new cap, the negotiated prices, the way Part D is structured now, the plan that was best for you 2 years ago may not be the best one this year. Premiums, covered drug lists, and pharmacy preferences shift every single year, and most people never look again after they first sign up. That's a mistake that quietly costs hundreds. So once a year, in that fall open enrollment window, run your actual prescriptions through Medicare's Plan Finder on Medicare.gov, or have someone do it with you. It takes 20 minutes, it's free, and with everything that just changed on the drug side, this is the year it's most likely to find you real savings. Don't auto-renew on autopilot. Quick one, because it genuinely helps the channel and helps me cover the right things. Drop a comment and tell me which of these 3 is the one you didn't know about. The deduction, the drug cap, or change number 3 coming up. I read them, and the pattern tells me what to dig into next. Okay, change 3, and this is the one that quietly costs the most people the most money. Change number 3 isn't new this year, but it catches a new wave of retirees every single year, and almost nobody knows the fix. It's called IRMAA, an income-related surcharge that gets added on top of your Medicare Part B and Part D premiums if your income is above a certain line. And here's the cruel part. It's based on your income from 2 years ago. So your 2026 Medicare premium is set by what you earned in 2024, back when you might still have been working full-time. Picture the trap. You retire in 2025. Your income drops like a rock. But in 2026, Social Security looks back at your high 2024 income, the year you were still earning, and stacks a surcharge on your Medicare premium based on money you no longer make. People open that letter, see their premium jumped by hundreds of dollars a month, and just pay it, thinking there's nothing they can do. There is something you can do, and it's one form. Here's what makes IRMAA especially brutal, and why getting it reversed matters so much. It's not a gentle slope, it's a cliff. The surcharge works in tiers, and the moment your income crosses a bracket line by even a single dollar, the whole next tier's surcharge kicks in. Not $1 of surcharge for $1 of income, the entire step. So, a tiny difference in your 2-year-old income, one extra withdrawal, one capital gain, can flip you into a higher tier and cost you hundreds more a month across Part B and Part D both. That's why people are so shocked by the letter. A small income difference, a big premium jump. And it's exactly why, when your real income is lower now, you want that recalculation. You may be sitting $1 into a tier you don't belong in anymore. The fix is Form SSA 44. If your income went down because of a specific life-changing event, you retired, you cut your hours, you lost a spouse, you divorced, you lost a pension or income-producing property, you do not have to wait 2 years for Medicare to catch up. You file Form SSA 44, you show them the event, and they recalculate your surcharge based on what you actually make now. That can knock hundreds of dollars a month off your premium, money you'd otherwise hand over for 2 full years for no reason. This is the single most overlooked move in Medicare, and I did a complete video on IRMAA and this exact form. That's the other one to watch. Let me put a face on it, because this is the kind of thing that sounds small until it's your letter. Picture someone who sold a business or took one big retirement account withdrawal in 2024, pushing their income up for that 1 year. In 2026, Medicare looks back, sees that spike, and hits them with a surcharge that can run a few $100s a month, on top of the normal premium across both Part B and Part D. Over a year, that's thousands. They file SSA 44. They show that their real ongoing income is far lower now, and the surcharge comes off. Same person, same Medicare, one form, thousands of dollars. That's why I say this is the most overlooked move on the whole list. One honest caution, so you do it right. SSA 44 is for a genuine life-changing event, retiring, losing a spouse, cutting your hours, that kind of thing. It is not a tool for, my income just happened to be high 2 years ago for no particular reason. If you had a one-time spike with no qualifying event, there's a different path, a regular appeal, and it's a longer road. So match your situation to the right form. But if you did have a real life change, do not leave that surcharge sitting on your premium. The full walkthrough, the brackets, the form, the appeal versus SSA 44, is in my IRMAA video, and it's the one I'd send to anyone who just got a scary Medicare letter. Now let me head off something you've probably seen all over your feed, because it ties these together. You'll see thumbnails screaming that Social Security took back your raise through your Medicare premium. Here's the honest version. Yes, the cost of living raise bumps your checkup, and yes, a rising Part B premium comes out of that same check, so the net raise can feel smaller than the headline. But there's a protection called hold harmless that for most people keeps your net Social Security check from actually going down year to year because of the Part B increase. So your raise is real. Watch the Part B line, sure, but don't let a doomsday thumbnail talk you into a panic move. Decisions made out of fear are how people lose money, not save it. So if the "they stole your raise" headline is mostly noise, what should you actually watch? Two numbers, once a year, usually in the fall. 1. The cost of living percentage. That's how much your gross Social Security goes up. 2. The new standard Part B premium. That's the piece deducted from your check for Medicare. Put those side by side and you'll know your real net change before January even arrives, instead of being surprised by the first deposit. And here's the honest nuance most videos skip. If you're a higher income retiree paying that IRMAA surcharge we just covered, hold harmless does not fully protect you the way it protects most people. Which is one more reason the SSA 44 move can matter. It all connects. Watch the two numbers, know whether IRMAA touches you, and the COLA stops being a mystery you react to and becomes a number you planned for. So step back and look at what these three have in common. Every one of them is money. The rules are trying to give you or save you. A deduction you're owed, a cap that protects you, a surcharge you can reverse. And every one of them gets missed for the same reason. Nobody handed you the one form or the one number. That's the whole game in retirement money. It's almost never about some secret trick. It's about knowing which ordinary rule applies to you and taking the one boring step to claim it. Before I give you the checklist, let me name the 3 mistakes that make people miss all of this, because if you can dodge these, you're ahead of almost everyone. Mistake 1. Assuming my taxes are simple, so there's nothing to find. A brand new deduction is exactly what simple return software and old habits skip. Mistake 2. Assuming you earn too much to qualify for help, with extra help, with anything, and never actually checking. The rules decide that, not your gut. And mistake 3, the big one. Opening an official letter that says you owe more, sighing, and just paying it, the higher Medicare premium, the surcharge, without asking whether a form could change it. In retirement, just pay it is the most expensive instinct there is. Every single thing on this list rewards the person who asks one more question instead of assuming the letter is final. And let me say why I cover these the way I do. Calm, sourced, no screaming thumbnails. Your feed is full of people turning every one of these into panic. Shocking change. Act before it's too late. They're coming for your benefits. That noise doesn't help you, it just gets you to click, and worse, it pushes people into fearful, rushed decisions that cost them money. The real changes, the ones that actually matter, are usually quiet, boring, and genuinely good for you, like a deduction or a cap. My whole job here is to hand you the real ones plainly, tell you who they're for, and give you the one step. No fear, no pitch. If that's what you want from a retirement channel, you're in the right place. So here's your checklist for this week. 3 numbers, 3 actions. 1. If you're 65 or older, ask whether you got the $6,000 senior deduction on your last return, and if not, ask about amending. 2. If you take expensive prescriptions, look at your Part D plan and know your $2,100 cap, and check extra help if money is tight. 3. If your income dropped because you retired or lost a spouse and your Medicare premium looks too high, get Form SSA 44. That's it. 3 checks. Most people watching will find real money in at least one. One more practical layer, because do it this week only helps if you know the windows. The tax deduction. You generally have up to 3 years to amend a return, so if you missed it on your 2025 filing, you've got real time. But don't sit on it. The Medicare drug cap. That's automatic, nothing to file, it just protects you all year. But if your plan is the problem, your drugs aren't covered well, or your copays are high, the time to switch Part D plans is Medicare's open enrollment in the fall, October 15th to December 7th. Mark it, and Form SSA 44. You can file that one anytime after a qualifying life event. You don't wait for a season, you do it as soon as your income drops. So, amend within 3 years, change your drug plan in the fall, and file SSA 44 the moment your life changes. Right tool, right window. If you remember one thing, remember this. The most expensive thing in retirement isn't a bad investment. It's a good rule you didn't know applied to you. A deduction, a cap, a surcharge you could have reversed. None of these took a genius. They took one person telling you plainly and one small step. Now you've got all three. Go check the one that's yours. Quick and important. This is educational, not financial advice, and not tax or medical advice either. These are 2025 and 2026 figures from the IRS, Medicare, and Social Security. So confirm your own situation at irs.gov, medicare.gov, ssa.gov, or with a licensed professional before you act. If this was useful, subscribe. I do one of these honest breakdowns a week. And I've got the full deep dives on 2 of these, the $6,000 senior deduction and the IRMAA surcharge with the SSA 44 walkthrough. I'll put both on screen now. Tell me in the comments which one you're checking first. I'll see you in the next one.